If you're new to investing and feeling a bit overwhelmed by the stock market, you've come to the right place. This ultimate stock market investing guide for beginners video will break down everything you need to know to get started on your investment journey. We'll cover the basics, explore different investment styles, and even discuss some key strategies to help you build wealth over time. So, grab a cup of coffee, get comfortable, and let's dive in. Disclaimer: this information is for educational purposes only and should not be considered financial advice. Let's start with the big question. Why should you even consider investing in the stock market? The stock market has historically been one of the most effective ways to grow wealth over the long term. Think about it. Over the past 30 years, the S&P 500, a broad market index, has delivered an average annual return of around 9.9%. Looking further back, over 50 years, that average return climbs to roughly 10.8%. And if we go all the way back to the early 1900s, the stock market has shown an average annual return of approximately 10.5%. Now it's important to remember that the market isn't a straight line upwards. There will be ups and downs, even significant crashes like we saw in 2008 and 2020, but the long-term trend consistently points towards growth. Investing in the stock market is not about perfectly timing the market, trying to buy low and sell high every time. It's about time in the market. Consistent long-term investing is key to reaping the rewards of market growth. Think of it like owning a home. 100 years ago, the median home price in the United States was a mere $3,200. Today, that number has skyrocketed to around $400,000. Real estate, like the stock market, appreciates in value over time. Whether your goal is to build a comfortable retirement nest egg, save for a down payment on a house, or simply grow your wealth over time, the stock market offers a powerful tool to achieve your financial aspirations. So, what exactly are stocks? In simple terms, stocks represent ownership in a company. Imagine you own a small bakery. To expand your business, you need to invest in new ovens, hire more bakers, and maybe open a second location. To raise the necessary funds, you could sell a portion of your bakery to investors. Each investor who buys a piece of your bakery receives a share of ownership. These shares are what we call stocks. When you buy a stock in a publicly traded company like Apple, Microsoft, or Amazon, you're essentially becoming a part owner of that company. Your ownership stake might be small, but you're entitled to a portion of the company's profits. These profits can be distributed to you in the form of dividends, which are regular cash payments made to shareholders. Alternatively, the company's profits can be reinvested back into the business, leading to increased growth and potentially higher stock prices. Companies offer their shares for sale on the stock market, which is essentially a vast marketplace where investors can buy and sell these shares. The beauty of the stock market is that you don't need to be a millionaire to get started. You can begin investing with as little as $10 or even less, depending on the brokerage platform you choose. Ready to take the plunge? Here's a step-by-step guide to get you started on your investment journey. Open a brokerage account. Choosing a brokerage. Selecting the right brokerage platform is crucial. Consider these factors. Fees. Compare commission fees, if applicable, trading fees, account maintenance fees, and any other associated costs. Many brokerages now offer commission-free trades, but be sure to read the fine print. Features. Look for features like user-friendly platforms, mobile app, desktop interface, research tools, stock quotes, news, analyst reports, educational resources, articles, webinars, and investment options, stocks, ETFs, bonds, mutual funds. Customer support. Evaluate the quality of customer service. Check their availability, phone, email, chat, and how responsive they are to inquiries. Security. Ensure the brokerage platform has robust security measures to protect your account and investments. Popular brokerage options. Fidelity, known for its strong research tools, educational resources, and excellent customer service. Vanguard, a pioneer in low-cost investing, known for its index funds and ETFs. Questrade, a Canadian-based brokerage with a focus on technology and competitive pricing. Moomoo, a mobile-first brokerage with a user-friendly interface and competitive fees. TD Ameritrade offers a wide range of investment options and robust trading tools. Research and compare. Don't just choose the first brokerage you come across. Take the time to research different platforms and compare their offerings to find the one that best suits your needs and investment style. Fund your account. Transfer funds. Transfer funds from your bank account to your brokerage account using electronic transfer, ACH, or wire transfer. Start small. Begin with an amount you're comfortable investing and gradually increase your contributions over time. Consider automating investments. Set up automatic transfers from your bank account to your brokerage account on a regular schedule, for example, weekly or monthly. This helps to build discipline and ensure consistent investing. Conduct thorough research, company research fundamentals. Analyze a company's financial statements, income statement, balance sheet, cash flow statement, to understand its profitability, growth potential, and financial health. Competitive advantage. Assess the company's competitive advantages, strong brand, unique technology, strong customer base, that give it an edge in the market. Industry trends. Research the industry in which the company operates and identify any emerging trends or challenges that could impact its future growth. Index funds and ETFs diversification. Invest in index funds or ETFs that track a broad market index like the S&P 500. This provides instant diversification across a wide range of companies. Low-cost index funds and ETFs typically have low expense ratios, which can significantly impact your long-term returns. Avoid speculative stocks. Penny stocks. These are low-priced stocks of small, often unknown companies. They are highly speculative and carry a significantly higher risk of loss. High volatility sectors. Avoid investing in sectors known for extreme price fluctuations such as cryptocurrency or certain biotech companies, especially when starting. Place your first order types. Familiarize yourself with different order types such as market orders, execute immediately at the current market price, and limit orders. Execute only if the stock price reaches a specific price. Review and confirm. Carefully review all order details before submitting your order. Start small. Begin with a small investment amount to gain experience and gradually increase your investment size as you become more comfortable. Remember, investing is a long-term endeavor. Don't expect to get rich quick. Focus on building a solid foundation and gradually increasing your investments over time. Now, let's explore some of the different investment styles you can adopt. There's no one-size-fits-all approach, so it's important to choose a strategy that aligns with your financial goals, risk tolerance, and time horizon. First up, buy and hold investing. This is often considered the cornerstone of long-term investing. It emphasizes patience and a long-term perspective. You select high-quality stocks or index funds and hold them for an extended period, typically several years or even decades. You essentially ride out the inevitable market ups and downs, allowing your investments to grow over time. The key benefits of this strategy are its simplicity, ease of implementation, and minimal active management. Compounding also plays a significant role here. Reinvested dividends and capital gains compound over time, significantly boosting your returns. Plus, it reduces stress by minimizing the emotional impact of short-term market fluctuations. For example, investing in S&P 500 index funds like the Vanguard 500 Index Fund and holding them for over 20 years, or buying shares of high-quality companies with strong fundamentals and holding them for the long haul. Next, we have trading. This involves frequent buying and selling of stocks to capitalize on short-term price movements. There are different types of trading: day trading, where you buy and sell stocks within the same trading day; swing trading, where you hold positions for a few days or weeks to profit from short-term price swings; and short selling, where you borrow shares of a stock, sell them, and then buy them back at a lower price to return them to the lender. Trading is demanding and requires significant time, research, and emotional discipline. It's high risk and involves a higher risk of losses due to the inherent volatility of short-term price movements. Generally, it's not recommended for beginners due to its complexity and potential for significant losses. Then, there's dividend investing. This strategy focuses on companies with a history of paying regular dividends to shareholders. You invest in companies that consistently pay dividends and reinvest those dividends to purchase more shares, increasing your ownership stake and compounding your returns. The benefits include a regular stream of income, which can be particularly beneficial during retirement, and long-term growth from reinvested dividends. Examples include investing in companies like Johnson & Johnson and Procter & Gamble, known for their consistent dividend payouts. Lastly, we have speculative investing. This involves investing in assets with high potential returns, but carries a significantly higher risk of loss. Examples include penny stocks, which are low-priced stocks of small, often unknown companies; cryptocurrency, which are highly volatile digital currencies; and emerging markets, which are stocks of companies in developing economies. Speculative investing is high risk and can lead to substantial losses if the investment does not perform as expected. It's generally not suitable for beginners due to the high risk involved, and if you choose to engage in it, it's wise to limit your exposure to a small portion of your overall portfolio. As a beginner, I strongly recommend starting with a simple, long-term approach like buy and hold investing or dividend investing. These strategies allow you to build a solid foundation, minimize risk, and benefit from the power of compounding over time. By carefully considering your financial goals, risk tolerance, and time horizon, you can choose the investment style that best suits your individual needs and preferences. Index funds, what are they? Index funds are a type of mutual fund that aim to mirror the performance of a specific market index. For example, an S&P 500 index fund seeks to replicate the performance of the S&P 500, which includes 500 of the largest publicly traded companies in the United States. Key features: diversification. By investing in an index fund, you automatically gain exposure to a wide range of companies across various sectors of the economy. This diversification helps to reduce risk. Passive management index funds are passively managed, meaning they don't require active stock picking by a fund manager. This keeps costs low. Low costs, expense ratios, or annual fees charged by the fund for index funds are typically very low, which can significantly impact your long-term returns. Accessibility: index funds are widely available and can be purchased through most brokerage platforms. ETFs or exchange-traded funds. Similar to index funds, ETFs often track a specific market index just like index funds. Key differences: traded like stocks. ETFs trade on stock exchanges throughout the trading day, just like individual stocks. This provides more flexibility compared to traditional mutual funds, which can only be traded at the end of the trading day. Lower minimum investments. ETFs often have lower minimum investment requirements than traditional mutual funds, making them more accessible to smaller investors. Tax efficiency. Some ETFs can be more tax efficient than traditional mutual funds, particularly for frequent traders. Benefits for beginners. Simplicity. Both index funds and ETFs are relatively simple to understand and invest in. Low risk. They offer a more diversified and less risky approach compared to investing in individual stocks. Long-term growth. They provide exposure to the overall market, allowing you to participate in long-term market growth. Low costs. Low expense ratios contribute to higher long-term returns. Examples: index funds, Vanguard 500 Index Fund, 𝗣𝗟𝗓𝗗𝗃, S&P 500 Index Fund, 𝗣𝗟𝗏𝗏. ETFs, SPDR S&P 500 ETF Trust 𝗣𝗏𝗏, iShares Core S&P 500 ETF IVE. In summary, both index funds and ETFs are powerful investment vehicles that offer numerous benefits for beginners. They provide a simple, low-cost, and diversified way to invest in the stock market and participate in long-term market growth. Price and volume. Price. Monitor the stock's current market price and track its price movements over time. Consider factors like industry trends, economic conditions, and company-specific news that may be impacting the stock price. Volume. Trading volume refers to the number of shares of a stock that are traded during a given period. High trading volume generally indicates that the stock is actively traded, which can make it easier to buy or sell shares quickly at a fair price. Low trading volume can make it difficult to buy or sell large quantities of shares without significantly impacting the stock price. Historical performance. Long-term trends. Analyze the stock's past performance over different time periods, such as 1 year, 5 years, and 10 years. Look for consistent growth and identify any recurring patterns or trends in the stock's price movements. This can help you assess the company's historical performance and identify potential growth opportunities. Compare to the market. Compare the stock's performance to the overall market, like the S&P 500, to determine whether it has outperformed or underperformed the market. P/E ratio or price-to-earnings ratio, what it measures. The P/E ratio compares a company's stock price to its earnings per share, or EPS. It indicates how much investors are willing to pay for each dollar of the company's earnings. Interpretation. A high P/E ratio suggests that investors have high expectations for the company's future growth. A low P/E ratio may indicate that the stock is undervalued. Considerations. P/E ratios can vary significantly across different industries. It's important to compare a company's P/E ratio to the average P/E ratio of its industry peers. Dividends, dividend yield. The dividend yield represents the annual dividend payment per share as a percentage of the stock's current price. A higher dividend yield generally indicates a higher dividend payout. Dividend history. Analyze the company's dividend history to assess its consistency in paying dividends. Look for companies with a long history of increasing dividend payments, often called dividend aristocrats. Dividend reinvestment. Consider reinvesting dividends to purchase more shares of the company or other investments, which can significantly boost your long-term returns. Financial health. Key financial statements. Balance sheet shows a company's assets, liabilities, and shareholder equity at a specific point in time. Income statement shows a company's revenues, expenses, and profits over a specific period. Cash flow statement shows the flow of cash into and out of the company. Key indicators. Revenue growth. Look for consistent revenue growth and identify the drivers of that growth. Profitability. Analyze key profitability metrics such as net income margin and return on equity. Debt-to-equity ratio. This ratio measures a company's financial leverage. A high debt-to-equity ratio indicates higher financial risk. Where to find information? Financial websites, Yahoo. Finance provides comprehensive financial data, news, and research tools. Google Finance offers real-time stock quotes, charts, and financial news. Bloomberg, a leading provider of financial data and news for professionals. Reuters, another major source of financial news and information. Brokerage platforms. Most online brokerage platforms provide access to research tools, financial data, and even stock screening tools. Important note: thorough research is crucial before investing in any individual stock. However, it's important to remember that past performance is not indicative of future results. Emotional investing. Fear and greed. Fear. Market downturns can trigger fear and anxiety among investors, leading to panic selling. Selling stocks during a market decline can lock in losses and prevent you from participating in the market's eventual recovery. Greed. The temptation to chase hot stocks or invest in speculative assets can lead to impulsive decisions and potential losses. Staying disciplined. Long-term perspective. Maintain a long-term investment horizon and stick to your investment plan regardless of short-term market fluctuations. Avoid emotional reactions. Base your investment decisions on sound research and analysis rather than on fear, greed, or media hype. Regularly review and rebalance. Periodically review your portfolio and rebalance it to maintain your desired asset allocation. Overtrading transaction costs. Frequent trading can significantly increase transaction costs, including brokerage fees and taxes. Increased risk. Frequent trading increases your exposure to market volatility and increases the likelihood of making impulsive decisions. Focus on long-term. Buy and hold. Implement a buy and hold strategy for a significant portion of your portfolio. Avoid chasing short-term gains. Focus on long-term growth and avoid the temptation to constantly trade in and out of stocks. Lack of diversification. Reducing risk. Diversification is crucial for reducing overall portfolio risk. Asset allocation. Distribute your investments across different asset classes like stocks, bonds, and real estate, and sectors, such as technology, healthcare, and energy. Geographic diversification. Consider investing in international stocks to diversify beyond the domestic market. Benefits of diversification. Helps to mitigate losses during market downturns. Improves the overall risk-adjusted return of your portfolio. Timing the market. The illusion of control. Attempting to time the market by predicting market peaks and troughs is extremely difficult and often unsuccessful. Focus on time in the market. Instead of trying to time the market, focus on consistently investing over time. This allows you to benefit from the long-term growth of the market, regardless of short-term fluctuations. Dollar cost averaging. Invest a fixed amount of money at regular intervals like monthly, regardless of market conditions. This helps to average out the cost of your investments over time. Building wealth through consistency, long-term perspective. Investing in the stock market is a long-term endeavor. Focus on building a solid foundation and gradually increasing your investments over time. Avoid short-term pressures and maintain a patient and disciplined approach. Compounding. Reinvest your dividends and capital gains to compound your returns. Compounding allows your investments to grow exponentially over time. Continuous learning. Stay informed about market trends and economic developments. Continuously educate yourself about investing and refine your investment strategy. By being mindful of these common pitfalls and adhering to a disciplined investment strategy, you can significantly improve your chances of success in the stock market. Now that you have a strong grasp of the basics, let's dive into some advanced investment strategies that can help you elevate your portfolio. These strategies are designed for investors who are comfortable with the fundamentals and are looking to optimize their returns. First, let's talk about options. Options are financial derivatives that give you the right, but not the obligation, to buy or sell a stock at a predetermined price before a specific date. This strategy can be used for hedging risks or for speculating on the future direction of a stock's price. However, options trading is highly complex and carries significant risk, so it's crucial to educate yourself thoroughly before diving in. Another advanced strategy is short selling. This involves borrowing shares of a stock you believe will decrease in value, selling them at the current market price, and then buying them back at a lower price to return to the lender. While short selling can yield high profits, it also comes with unlimited risk, as there is no cap on how high a stock's price can rise. For those interested in diversifying beyond traditional stocks, consider real estate, commodities, or private equity. These assets often have a low correlation with the stock market, providing a hedge against market volatility. However, they also come with their own set of risks, and are typically less liquid than stocks. Lastly, let's explore algorithmic trading. This involves using computer algorithms to execute trades at high speeds and volumes based on predefined criteria. Algorithmic trading can take advantage of market inefficiencies and execute complex strategies that would be impossible for a human to perform manually. However, it requires significant technical expertise and access to sophisticated software. Remember, advanced strategies can offer higher returns but also come with increased risk. It's essential to continue your education, practice due diligence, and consult with financial professionals when necessary. As we wrap up our exploration of advanced investment strategies, it's crucial to look ahead and consider what the future holds for the stock market. The financial landscape is constantly evolving, influenced by technological advancements, regulatory changes, and shifts in global economic dynamics. One of the most significant trends shaping the future is the rise of blockchain technology. This technology has the potential to revolutionize the stock market by providing greater transparency, reducing fraud, and enabling faster and more secure transactions. Blockchain could also pave the way for the emergence of decentralized finance, or DeFi, which aims to create a more open and accessible financial system. Another key development is the increasing role of AI. As these systems become more sophisticated, they are being used to analyze vast amounts of data, identify market trends, and execute trades with unprecedented speed and accuracy. While AI can offer significant advantages, it also raises ethical and regulatory concerns that will need to be addressed. Additionally, the shift towards AI is transforming how companies are valued and how investors make decisions. As awareness grows about the impact of corporate actions on the environment and society, investors are increasingly considering factors such as carbon footprint, social responsibility, and corporate governance in their investment choices. This trend is likely to continue, driving more companies to adopt sustainable practices and transparent reporting. The future of the stock market also includes the rise of cryptocurrencies, where traditional financial institutions integrate digital assets like cryptocurrencies into their offerings. This integration is expected to open up new investment opportunities and attract a broader range of investors, from retail to institutional. Lastly, the ongoing globalization of financial markets means that investors will have access to a wider array of investment opportunities from around the world. However, this also brings challenges, such as navigating different regulatory environments and understanding diverse market dynamics. In conclusion, the future of the stock market promises to be dynamic and filled with opportunities. Staying informed and adaptable will be key to navigating this ever-changing landscape. Thank you for joining us on this journey through the world of investing. I hope this video has provided you with a solid foundation for your investment journey. Remember to do your own research, consult with a financial advisor if needed, and always invest responsibly. Thank you for watching. If you found this video helpful, please like and subscribe to our Stocks Galore YouTube channel for more investing tips. If you need a deeper dive into understanding value stocks investing, I've put together an in-depth course for you, Value Stock Investing Master Course. You can find the link at stocksgaloremedia.com, on our YouTube page, and inside our Patreon community. Also, join our Stocks Galore Patreon community to learn more about investing to grow your wealth. Until next time, happy investing.